Welcome to the Deep Dive.
Hello.
Today, we're doing what we do best, taking a key document and really unpacking it for you.
Getting right to the core of it.
Exactly. Our source today is the 2022 Shareholder Letter from Goldman Sachs. It's signed by the top brass. David Solomon, the CEO, John Waldron, President and COO, and Dennis Coleman, the CFO.
And this letter, it's important because it covers quite a span. Their journey since that first investor day in January 2020, right?
Right, and how they dealt with, well, a pretty challenging couple of years globally.
Yeah, how their strategy changed, evolved,
Yeah.
and what they're focused on now looking ahead.
So our mission really is to cut through the corporate speak and pull out the key insights, the important nuggets for you, give you a solid handle on where this major firm stood heading into 2023.
Okay, so let's jump in. Where do we start? Maybe that 2020 investor day plan.
Yeah, good starting point. January 2020. What was the initial game plan?
Well, they laid out a pretty clear four-part strategy, as I recall.
First was investing in the core businesses, right? The traditional strengths.
Exactly, doubling down there. Second, they targeted four specific areas for growth:
Which were?
asset management, wealth management, transaction banking, and interestingly, consumer banking.
Okay. Those were the growth bets.
Then third, a big push on efficiency, running the whole firm smarter, leaner.
Makes sense.
And fourth, and this was kind of a big deal for them, they set public, firm-wide financial targets for the first time.
Ah, for accountability. Putting numbers out there.
Precisely. A clear path, measurable results. That was the idea.
Okay, so that's the plan from early 2020. But the world didn't exactly cooperate, did it?
No, not at all. And the letter is quite upfront about that, acknowledging the unexpected shocks they faced almost immediately.
We're talking the pandemic, obviously.
The pandemic, the war in Ukraine, that big surge in inflation, and then central banks hitting the brakes with monetary tightening. A perfect storm, really.
So how did that turbulent environment actually hit their business, especially in 2022?
Well, it created pretty significant headwinds, as they put it. Their business mix, which did great in 2021's environment.
Low rates, high activity.
Exactly. It faced challenges in 22, like a really sharp drop in capital markets issuance.
So fewer IPOs, less debt being issued.
Right. And asset prices falling across the board, which hits their investments, hits their management fees.
Okay.
They also point out, quite fairly, that the strategic investments they were making, acquisitions, tech upgrades, those were weighing on short-term results too, even if they're key for the long run.
So a plan meets reality.
Yeah.
Intense reality. How did they actually perform overall across that whole 3-year window from the investor day through end of 2022?
Despite that tough 2022, the cumulative picture they paint for those 3 years is actually quite strong.
Really?
The total shareholder return was 60%, and they emphasized that meaningfully outperformed their peers.
6% over that period is definitely significant.
It is. And book value per share, up nearly 40%, which they note is roughly double their closest competitor.
Wow. Okay. And earnings.
Earnings per share, also up over 40% across the 3 years.
And they gave cash back to shareholders, too.
A lot. Nearly $18 billion returned to common shareholders. Buybacks, dividends, the whole lot.
And crucially, how did they do against those targets they set back in 2020, the ROE and ROTE goals?
Their average returns over the 3 years were right in line with those targets. That's the 14–16% ROE range and 15–17% ROTE.
Okay, maybe quickly define ROE and ROTE for us?
Sure. ROE, return on equity, is pretty standard. Net income divided by shareholder equity shows profitability relative to the investment.
Got it.
ROTE, return on tangible equity, is similar, but it strips out intangible assets, things like goodwill from acquisitions.
Ah, okay. So it focuses more on the return from the sort of hard assets.
Exactly, the physical and financial capital base. It's a key metric they use, investors use, especially after big deals, to see the underlying operational performance.
And their average ROE was?
Their 3-year average ROE was 14.8%, which they point out was significantly above peers, even adjusting for some litigation impact back in 2020.
Okay, so the 3-year view, according to them, looks pretty solid despite the turbulence.
That's the message.
Now let's zoom in on 2022 itself, that tougher year. What were the headline numbers?
All right, for 2022 specifically, net revenues landed at $47.4 billion.
Okay.
Net earnings were $11.3 billion.
In per share?
Diluted earnings per common share came in at $30.06.
And those key return metrics for just the year 2022.
Lower, as you'd expect. ROE was 10.2% and ROTE was 11.0%.
So below their targets and way down from 2021, reflecting those headwinds.
Absolutely. It reflects those market conditions we talked about.
But they frame this, I imagine, in context.
They do. They stress that, look, despite the tough year, they delivered solid results, and importantly, they performed better than they would have 3 years ago in a similar weak issuance market.
Showing increased resilience is the idea.
That's the argument. And book value per share still grew 6.7% in 2022, which is quite healthy.
This seems like a good point to bring up something they highlight called the One Goldman Sachs philosophy. What's that about?
Yeah, they talk about this quite a bit. It's essentially their guiding principle for how they interact with clients.
Okay.
The idea is, in today's complex world, a client's needs often span multiple parts of Goldman. So One Goldman Sachs means breaking down those internal walls.
Bringing the whole firm to the client, basically.
Exactly. Bringing all the expertise, all the intellectual capital from across the different businesses to serve that client in a really joined-up, integrated way.
So less siloed, more seamless for the client.
That's the goal. They mention having senior partners who are responsible for the whole relationship with a key client, building dedicated teams from different areas.
And they say this helps the business, too.
Yeah, they state it's highly accretive, better for the client, obviously, but also better for Goldman by deepening those relationships and capturing more of the client's business.
And this client focus seems to be the logic behind that big reorganization they announced late in 2022.
Yes, absolutely. The strategic reorganization in December. They restructured into 3 core segments.
Why the change?
They frame it as the logical next step, building on that client centricity to create a more durable firm, one that can deliver higher returns more consistently through the ups and downs of economic cycles.
Okay, what are the 3 new segments?
First, Global Banking and Markets, or GBM. That's the core investment banking, trading, financing engine.
The traditional powerhouse.
Right. Second, Asset and Wealth Management, AWM. That combines, logically, their asset management arm and their private wealth business.
Makes sense. And the third?
A new one called Platform Solutions.
Platform Solutions. What falls under that?
This basically gathers their transaction banking business, cash management for corporates, and their consumer-facing platforms.
Like the Apple Card partnership.
Exactly. The card partnerships and also GreenSky, that fintech lender they acquired. It's grouping the tech-driven platform businesses together.
Okay, 3 segments: GBM, AWM, Platform Solutions. Clear structure. And they announced key priorities alongside this.
They did. 3 main execution priorities, mapping onto the new segments.
What are they?
For GBM, Global Banking and Markets, it's about maximizing wallet share, getting more business from existing clients, and growing their financing activities, lending more.
Okay. And for AWM, Asset and Wealth Management.
The big focus there is growing management and other fees. Predictable, recurring revenue from managing money and advice, rather than relying so much on, say, gains from their own investments.
More stable income streams.
That's the goal. And for the new Platform Solutions segment.
What's the priority there?
Pretty straightforward. Scale these newer businesses and make them profitable, turn them into contributors.
Acknowledging they need to get into the black.
Right. It's about driving those emerging platforms to profitability.
Okay, let's touch on how the underlying businesses actually did in 2022, keeping these future segments in mind. Global Banking and Markets first.
Sure. For 2022, net revenues in that area were $32.5 billion.
Which, as the letter notes, was down 12% from a record 2021. Reflects that market downturn.
It does. But they quickly pivot to highlight the strength and growth over the full 3-year period since 2020.
Maintaining leadership positions.
Yes. #1 in global, completed M&A 23 of the last 24 years, which is incredible. Top rankings in equity underwriting, high-yield debt.
And they also talked about growth beyond just deal rankings.
Yeah, growth in client relationships and significantly financing. They say they boosted wallet share by 370 basis points over 3 years.
Okay.
And really grew financing within FICC, that's fixed income, currencies, commodities, and equities. Those financing revenues hit over $7 billion in 2022, growing at a 16% compound rate.
So lending alongside trading and banking.
Exactly. And the improved relationships with top clients, now top 3 ranked with 77 of their top 100 institutional clients, up from 51.
So the message is the underlying franchise strengthened even if market conditions hurt the 2022 top line.
That's definitely the takeaway they're aiming for. Lower investment banking fees were significantly offset by much higher FICC revenues, shows diversification.
And advisory. M&A advice.
Actually, advisory net revenues were $4.7 billion, their second highest ever. So lots of advice happening, even if fewer deals closed in that environment.
Interesting. Okay, moving to asset and wealth management. Revenues were $13.4 billion in 2022.
Now, this segment saw a much steeper drop, down 39% from 2021.
Why so much larger?
It's mainly because the way it was reported previously included big gains on investments held on their own balance sheet. Those reversed in the down market of 2022.
Ah, so less about the core management business, more about market swings on their own book.
Largely, yes.
Yeah.
Strategically, though, this combined AWM segment is now huge, over $2.5 trillion in assets under supervision, top 5 global active manager, top 5 in alternatives.
And fundraising, was that tough in 2022?
Actually, a record year for alternatives fundraising for them, holding $72 billion.
Oh, wow.
Yeah, brings them to nearly $180 billion raised since 2019, closing in on a $225 billion target. And interestingly, $27 billion of that 22 fundraising came through their wealth platform.
Showing that synergy they wanted by combining them.
Exactly. Proof of concept.
And within wealth management itself, they see more growth.
Definitely. They point out things like they only have loans with about 30% of their U.S. private wealth clients. Huge room to grow lending there.
To that very high net worth base managing over $1 trillion.
Right. And the letter really stresses the strategic shift towards growing the steadier revenues. Management fees, which hit $8.8 billion, on track for their $10 billion plus target by 2024, and private banking and lending revenues, which grew strongly.
Got it. Okay, finally, platform solutions. Sounds like some strategy shifts happened here.
Yes, this segment's still small overall, but the letter is pretty candid. They made a key decision in 2022 to significantly narrow their ambitions for the broad consumer strategy.
Meaning pulling back from the Marcus Consumer Bank idea.
That seems to be the implication. Less focus on building a mass-market digital bank. The focus now is on a smaller, more targeted set of businesses within platform solutions.
Right.
Like transaction banking, the card partnerships, driving those to profitability.
And they even mentioned strategic alternative.
It did, for some consumer platforms, which, often means they're looking at selling or winding down certain parts.
But they still see value in the remaining platforms.
Yes, they express belief that these are attractive businesses, potential for stable, recurring revenue interest income, fees from innovative, tech-based products, just maybe not the broad consumer play initially envisioned.
Okay, let's pivot to firm-wide expenses. How did costs look in 2022?
Total operating expenses were $31.2 billion, actually down 2% from 2021.
But I thought headcount went up. How did expenses go down?
Good point. Compensation and benefits fell sharply by 15%. That reflects the lower profits in 2022. The bonus pool shrank.
Ah, okay. Variable comp.
Right. But that big drop in comp was largely offset by higher non-compensation expenses.
What drove those up?
Mostly costs tied to their acquisitions, deal transaction costs, continued heavy spending on technology, and also higher market development costs as things opened up post-pandemic.
So they're actively trying to manage those non-comp costs.
Yes, they stress an active focus on operating efficiency and expense mitigation efforts.
Got it. Let's quickly touch on the balance sheet. End of 2022 snapshot.
Healthy. Balance sheet was $1.4 trillion, relatively flat year over year, but they actively managed it down quite a bit from Q3.
And deposits.
Deposits grew nicely, up about $23 billion year over year to $387 billion. That reflects growth in the private bank, consumer platforms that remain, and transaction banking.
And their capital position. You mentioned the targets earlier. How did they end the year?
Very strong. Their main capital ratio, the standardized CET1 ratio.
Common Equity Tier 1.
Right. It ended the year at 15.0%. That was up 80 basis points from the year before.
And how does that compare to what regulators require?
It gives them a really healthy cushion. Their requirement starting in 2023 was 13.8%, so they had a 120 basis point buffer. Very comfortable position.
And capital returned to shareholders in the year 2022 itself.
$6.7 billion returned to common shareholders just in 2022. That was split. $3.5 billion in share buybacks and $3.2 billion paid out in dividends.
Okay, so looking focused on the forward, as they title this section, how does the letter frame their position now with this structure and strategy?
They express a lot of confidence. The core message is that this new structure, the clarified priorities, it positions them really well to hit their financial targets through the cycle, not just in good years.
The key argument being,
that the actions they've taken, the strategic shifts, the investments have essentially raised the floor on their returns, meaning they should perform better even in tougher environments.
while keeping the upside.
Exactly. While retaining significant upside when markets are strong, aiming for less volatility, more consistent performance over time.
And they break that down by segment.
Yeah, briefly. For GBM, they see it positioned for strong returns with its integrated model focused on share gains and financing. More durable now.
Okay.
AWM, Asset and Wealth Management, is highlighted as the biggest growth opportunity. Operating at scale, leveraging the whole firm, focused on those durable fee and lending revenues.
In platform solutions.
Still potential there, they believe, for stable, recurring revenue from those emerging platforms, even with the narrowed focus.
Beyond the numbers and structure, they also talk about being more transparent.
Yes, they make a point of mentioning conscious efforts to be more open. Enhanced disclosures, more frequent investor events, strategic updates, laying out targets and KPIs, key performance indicators, so people can track progress.
Trying to be less of a black box.
Seems to be the goal.
And aligning pay with performance.
Yeah, a notable change mentioned. The management committee, the top leadership, now gets 100% of their annual stock compensation based purely on future results, performance shares.
Directly linking their pay to long-term shareholder value.
Exactly. Designed to enhance collaboration across the new segments and align everyone with long-term value. Plus, they note, many employees are shareholders too, creating natural alignment.
The letter also dedicates space to their people and diversity.
It does. Reaffirming commitment to recruiting, developing, promoting diverse talent. They mention progress on diversity goals at junior levels, analyst, associate, VP.
And the partner class?
They highlighted the 2022 partner class as their most diverse ever. But they also acknowledge there's more work to do, especially building and keeping a diverse leadership pipeline.
They also detail some significant community programs. It's not just a brief mention.
No, they go into some details, spotlighting things like 10,000 Women, which helps women entrepreneurs globally. It's hitting its 15th anniversary.
Okay.
And 10,000 small businesses focused on U.S. entrepreneurs, education, capital access, advocacy.
And the newer 1 Million Black Women Initiative?
Right, launched in 2021, building on lessons from the others. Already committed over $1 billion in investment capital and significant grant capital to organizations impacting Black women and girls.
So these are substantial long-term commitments.
Absolutely. Multi-year significant capital involving partnerships. They frame these as really core to the firm's purpose and values, contributing to that reputation asset they value so highly.
Sustainability is another theme.
Yes, they mentioned their focus goes back to 2005. More recently, they set that big 10-year target in 2019, $750 billion in sustainable financing, advisory, and investing.
Covering climate transition and inclusive growth, how's the progress on that $750 billion?
Pretty fast, actually. The letter states they achieved about 55% of that target in just the first 3 years.
Wow, over halfway there already.
Yeah, highlights significant activity and client demand in that space. Their approach is connecting finance with client needs and policy to direct capital towards the low-carbon transition. Again, emphasizing partnerships.
So wrapping it all up, the letter comes back to core values and purpose.
It does. They distill their business principles down to 4 core values: partnership, client service, integrity, and excellence.
And the purpose.
To aspire to be the world's most exceptional financial institution, united by those values. They briefly touch on underlying principles too: clients first, reputation being critical, quality, innovation, teamwork, diversity, integrity at the heart of it all.
And the final message on the path ahead.
It's one of real confidence. They believe they're very well positioned now because of the strategy, the culture, the talent, the track record, framing themselves as stewards of client trust.
The focus is execution now.
Squarely on executing against those priorities for the new segments, strengthening the franchise, delivering for shareholders, hitting those through-cycle returns, and importantly, raising the performance floor in tougher times.
And the ultimate sentiment.
A strong belief that if they stay true to their values, their strategy, their people, the best days for Goldman Sachs are still to come.
Well, that wraps up our deep dive into the Goldman Sachs 2022 shareholder letter.
We've covered a lot of ground: strategy evolution since 2020, navigating those global challenges, the financial performance, the big reorganization, key initiatives, and their commitments beyond just the bottom line: people, community, sustainability.
Thank you for joining us as we untacked this significant document.
And as you think about everything we've discussed, the impact of inflation and Market volatility, that pivot in the consumer strategy, the real doubling down on asset and wealth management, and scaling platform solutions alongside the core banking franchise. Here's something to consider.
Okay.
How might these strategic shifts, especially moving away from that broad consumer ambition and intensely focusing on specific platforms and asset gathering, how might that fundamentally change the overall risk profile and the earnings mix of this iconic institution in the years ahead? What does the Goldman Sachs of the future really look like?